When people hear the word stocks, they imagine a complicated world reserved only for experts in suits staring at charts all day. But here's the truth. Investing in stocks isn't about being a genius. It's about having the right mindset, the right habits, and the patience to let your money grow. I wasn't born knowing how to make millions from stocks. I started exactly where you are, confused, overwhelmed, and unsure of where to begin. The only difference is, I decided to learn to practice discipline and to stick with it long enough to see the results. And here's what I discovered: anyone can do this. You don't need to be rich to start, but you do need to start to get rich. Investing is not about luck. It's about knowledge, consistency, and emotional control. It's about planting seeds today that grow into forests tomorrow. So if you've ever felt like the stock market is too risky, too confusing, or too intimidating, I want to break it down for you in the simplest way possible. Because this isn't just about making money. It's about creating freedom. Freedom to choose how you live, freedom to protect your family, and freedom to stop trading time for dollars. Today, I'm going to show you the steps that help me go from beginner to building millions from stocks. And if you pay attention and apply these lessons, you can start writing your own story of financial independence. Most people lose money in the stock market not because the market is broken, the 48, but because they jumped in without a foundation. They see headlines, they hear about someone doubling their money, and they think, if they can do it, I can too. But investing is not a lottery ticket, it's a skill. And like every skill, it starts with learning the basics. If you don't understand what you're doing, you're not investing, you're gambling. The first thing to understand is this: the stock market is a place where ownership is traded. When you buy a stock at 8, you're not buying a piece of paper, you're buying a piece of a business. That means your mindset should shift from chasing prices to evaluating companies. Ask yourself, would I own this business if I couldn't sell it for the next 10 years? If the answer is no, you probably shouldn't buy the stock. Next, you need to grasp the idea of risk and reward. Every investment carries risk, but not all risks are created equal. Beginners often make the mistake of chasing high risk opportunities for quick profits, only to watch their money disappear overnight. Real wealth is built by managing risk, not avoiding it completely. That means learning to diversify, spreading your investments across different industries so that one mistake doesn't wipe out everything. Then there's the concept of compounding, the secret engine behind long-term wealth. Compounding means your money earns returns, and those returns start earning their own returns. It's like planting a seed. At first, the growth looks slow, but over time, it explodes into something massive. If you invest $500 a month at an average return of 10%, in 30 years, you don't just have 180,000, you have over $1 million. That's the power of compounding. But it only works if you understand it and give it time. Another critical basic is understanding the difference between trading and investing. Trading is about short-term moves, chasing quick profits, and often relying on speculation. Investing is about the long game, buying strong businesses and letting time do the heavy lifting. Beginners get burned because they confuse the two. They think they're investing, but really they're trading without the knowledge, and that's why they lose money. If you want to build millions, don't get lost in daily price movements. Focus on the big picture. You also need to learn the language of investing. Words like P/E ratio, dividends, market capitalization, and earnings per share might sound intimidating at first, but they're just tools to help you evaluate whether a company is healthy or not. The 48, you don't need to be an accountant, but you do need to understand what makes a company profitable, stable, and worth your hard-earned money. And perhaps the most important basic of all, know yourself. Before you risk a dollar, you must be clear about your goals and your tolerance for risk. Are you investing for retirement, for financial freedom, for building wealth for your kids, Your strategy depends on your purpose. If you don't know where you're going, you'll chase every shiny object the market throws at you, and that's a recipe for disaster. The truth is, knowledge is the cheapest investment you'll ever make, and it pays the highest dividends. You can avoid years of mistakes and thousands of dollars lost just by slowing down, reading a few good books, taking a beginner's course, or studying successful investors. Don't be in such a rush to make money that you skip the very lessons that keep you from losing it. So before you put your first dollar into the market, commit to learning. Learn the basics of how the stock market works, what makes companies valuable, and how to manage risk. Because when you master the foundation, every dollar you invest has the power to grow safely and steadily. But if you skip the basics, no amount of luck will save you. One of the biggest myths about investing is that you need a lot of money to begin. People say, I'll start when I have extra cash, or I'll wait until I'm making six figures. That's the mindset that keeps most people broke. The truth is, you don't need thousands of dollars to start investing. You just need consistency. Even the smallest amounts invested regularly can grow into a fortune over time. Think of it this way. Imagine two people. One starts investing $200 a month at age 20. The other waits until they're 30 to start and invests $500 a month. By the time both are 60, the first person who invested less money will often end up with more wealth. Why? Because of the power of consistency and compounding. 48 time multiplies your money, but only if you give it something to multiply. The earlier you start, the less you need to contribute, and the more freedom you'll have later. Starting small also removes excuses. Too many people say they can't invest because they don't have enough, but you don't need enough to begin. You just need to start. Whether it's 20 or 50 or 100 a month, what matters is not the amount, it's the discipline. Investing isn't about what you can do once, it's about what you can do repeatedly. Consistency beats intensity every single time. Here's the magic of consistency: it creates habits. When you automatically set aside a portion of your income for investing, it becomes second nature. Over time, you stop thinking about it, you just do it. And when life throws distractions or temptations your way, your system protects you. Most people fail at investing not because they don't know what to do, but because they don't stay consistent long enough to see results. Now let's talk about letting time do its work. The stock market isn't a get-rich-quick machine. It's a wealth-building machine. But it only works if you stay in long enough. There will be ups and downs, crashes and recoveries. The impatient investors panic and pull out during downturns, locking in losses. The consistent investors stay the course, keep adding, and let time smooth out the volatility. Over decades, the long-term trend of the market is upward. That's why patience is as important as discipline. This is where many beginners go wrong. They start small, but then they stop when they don't see immediate results. They check their account after a few months and think, this isn't working. But that's like planting a seed and digging it up every week to see if it's growing. Growth takes time. The first few years may not feel exciting, but stick with it, and one day you'll look back and be amazed at how far you've come. Consistency also protects you from trying to time the market. Nobody knows exactly when stocks will go up or down. Even the experts get it wrong. But if you're investing consistently, whether the market is high or low, you don't have to worry. You buy more shares when prices are low and fewer when prices are high. Over time, this strategy, known as dollar cost averaging, works in your favor. Starting small and staying consistent is more than a money strategy. It's a mindset. It teaches you discipline, patience, and trust in the process. It's proof that big results come from small actions repeated over time. And the best part, once you build the habit, it feels effortless. 8. Your money works for you while you focus on building your life. So stop waiting for the perfect moment, because it doesn't exist. The best time to start was yesterday. The second best time is today. No matter how small, take that first step, stay consistent, and let time do what it does best. Turn little into a lot. When most beginners step into the world of investing, they get distracted by the noise. Headlines scream about the next big stock, social media gurus hype up risky plays, and friends or coworkers brag about doubling their money overnight. This noise is dangerous because it pulls your attention away from the real secret of long-term investing, owning quality companies that stand the test of time. Here's the truth: wealth isn't built on chasing hype. It's built on holding strong, reliable businesses that grow steadily year after year. Think about companies that dominate their industries, provide essential products or services, and have proven track records of adapting and thriving no matter the economic climate. These are the companies that pay consistent dividends, reinvest profits into growth, and have leadership teams that know how to steer through challenges. Now let's break this down. What exactly makes a quality company? First, it's one with strong fundamentals. That means the company consistently earns profits, manages debt responsibly, and generates cash flow. These aren't always the stocks making headlines, but they're the backbone of wealth creation. For example, consumer goods companies, technology leaders, healthcare giants, and financial institutions that people rely on every single day. Second, a quality company has a competitive advantage. Maybe it's brand loyalty, like Apple. Maybe it's a massive network effect, like Microsoft. Maybe it's being so essential that people can't live without it, like a utility company. Whatever it is, that advantage protects them from competitors and allows them to keep growing even when the market is tough. Contrast that with chasing market noise. The hype-driven stocks may look exciting, but they're often built on speculation instead of substance. Sure, you might see them spike overnight, but what happens after the hype fades? They crash just as fast, leaving inexperienced investors panicking. The market is full of stories of people who lost fortunes chasing hot tips. Don't let that be you. The beauty of focusing on quality is that you don't have to check your portfolio every hour. Quality companies grow steadily in value, and when they do face downturns, they recover because their foundation is strong. They may not give you the thrill of quick wins, but they give you the peace of mind of lasting wealth. Remember, investing isn't about excitement, it's about results. Here's another key: when you focus on quality companies, you stop reacting emotionally. Market noise makes people emotional. They panic when prices fall, or they get greedy when prices soar. But if you've invested in strong businesses that you believe in, you can stay calm. You can remind yourself, this company isn't going anywhere. People still need its products. Its value will return. That mindset is priceless because it allows you to stay invested when others are bailing out. A powerful way to practice this is by thinking like an owner, not a trader. If you bought a restaurant or a small business, would you sell it tomorrow just because the economy dipped? No, you'd hold on, improve it, and wait for better days. Stocks work the same way. When you own shares of a quality company, you're literally a part owner of that business. So treat it that way. Finally, focusing on quality protects your time and energy. Instead of running after the latest news, you can set a strong foundation, invest in companies you trust, and then let them work for you. That's how you create freedom, when your money is invested in businesses that continue to grow while you live your life. So, here's the takeaway: ignore the noise. Don't let the hype distract you. Build your wealth on the shoulders of quality companies that have proven themselves over decades. Because while others are chasing trends, you'll be building something that lasts. And in the end, it's not the noise that makes you rich, it's the strength of what you own. One of the most dangerous mistakes beginners make when investing is putting all their money into a single stock, industry, or trend. It feels tempting. Maybe you believe one company is the next big thing, or you hear about someone making millions from one stock. But here's the truth. No matter how confident you are, no investment is 100% safe. That's why diversification is not just smart. It's essential if you want to protect and grow your wealth over the long run. Think of it this way: if you built a house, would you want it standing on just one pillar? Of course not. The stronger the foundation, the more pillars you have supporting it, the safer the house is. Diversification works the same way for your investments. It spreads your risk across different companies, industries, and even types of assets, so that if one area struggles, the others can keep your portfolio standing strong. Let's take an example. Imagine you put all your money into technology stocks. They might perform great when the tech industry is booming, but what happens if regulations change or the market dips? Suddenly, your whole portfolio crashes. But if you had diversified, adding healthcare, energy, consumer goods, and maybe even real estate, you'd still have parts of your portfolio holding strong while tech recovers. Diversification isn't about playing it safe, it's about playing it smart. It's like planting different crops in a field. Some might flourish one season, others might not, but overall, you ensure a steady harvest. That's the power of spreading risk. Now, diversification doesn't just mean buying random stocks. It means building balance. Stocks from different industries, yes, but also consider bonds, index funds, or even international investments. Each type of asset responds differently to changes in the economy. Stocks may rise when growth is strong, but bonds can protect you when markets are shaky. International exposure can give you access to growth in countries that are booming, even if your home economy slows down. Here's another key point. Diversification protects not just your money, but also your emotions. When you're all in on one investment, every dip feels like a personal disaster. But with a diversified portfolio, you don't panic as much. You know that while one part may be struggling, others are carrying the weight. That peace of mind is priceless. It allows you to stay consistent and not make emotional decisions that ruin your progress. Diversification also helps you ride out the storms. Markets will always have ups and downs. That's a fact. You cannot control that. But you can control how prepared you are. By diversifying, you're not betting on one outcome. You're preparing for multiple possibilities. Whether the economy grows fast, slows down, or faces unexpected shocks, you've positioned yourself to keep moving forward. Here's the mindset shift you need. Stop thinking like a gambler and start thinking like a builder. Gamblers go all in on one bet, hoping for instant wins. Builders lay bricks carefully, creating a structure that stands strong over decades. Diversification is how you build brick by brick without fear of losing everything to one bad bet. Finally, 8, protecting your wealth doesn't end with diversification. It also means regular review. A smart investor checks in on their portfolio, rebalancing when necessary. Maybe one sector has grown too large compared to others, so you shift funds to keep balance. Maybe new opportunities arise in emerging industries, so you spread your investment further. This discipline ensures that your portfolio stays healthy and aligned with your long-term goals. So, here's the lesson. Don't chase the thrill of putting it all on one play. Don't risk your future for quick wins. Spread your investments, balance your risk, and build a portfolio that stands like a fortress. Because wealth isn't about how much you make in one lucky moment. It's about how well you protect and grow it year after year. Diversification is your shield, your safety net, and your strategy for financial freedom.